Thank you very much. We really are the only part between now and drinks or going home, so just bear with us. Andrew and I are going to speak about cyber risk insurance market, and in particular do a little bit of a deep dive around FinTech cyber risk profile. So why is this important for the audience? Well, technology, people, and processes do fail. So insurance is a backstop to those types of risk issues, dealing with the financial consequences that arise.
Yeah, dealing with my own technological challenges here, but here we go. When we usually do presentations like this, we like to do a little bit of setting the scene, talking about the cyber threat landscape, what the attack trends we're seeing, and what the security trends are also. But we've had some people who are very well versed in those topics talk to you about threat hunting, intelligence sharing, and most recently, red teaming. So we're going to assume some knowledge in that area and dive into the challenges that we see in the cyber insurance market and the challenges for FinTech companies generally. So we've set out here what some of those challenges are, and I'll start with the first one, a lack of data. Cyber insurance is a relatively new product, so we routinely hear insurers tell us that we just haven't seen enough losses to really get comfortable with how we price the product, to what capacity we're willing to put up, what industries we're comfortable underwriting. Murray, in your experience, are those reasonable excuses for insurers not being able to be prepared to write this product?
Well, we have a lot of discussions with insurers and reinsurers, and we often hear a litany of truisms about the availability of data, systemic risk, the sophistication of hackers, and you know, the broader risk environment that is impacting the broader industry. So we look at the availability of data. If you take, for example, Cisco, they scan 600 billion emails a day and find 1.5 million unique malwares going around the world. There was a science publication that was produced with Lloyd's of London, and they referred to 32 million IP addresses within the Amazon cloud infrastructure just in the US. Our own database identifies around 45,000 significant cyber events, and that list is growing each month. We also look at the amount of new data that's becoming available. Also threat intelligence as a key component of that. Closer to home, the Monetary Authority of Singapore has promoted a project which is being run by the Singapore NTU and supported by insurance industry participants. And one of the key objectives of that project is to assist the insurance industry to develop actuarial models to better price cyber risk, to understand accumulation exposures, to understand the volatility, the frequency of cyber events, not just in Singapore, but regionally and globally.
And we know when we see those studies, and so we'll see what comes out of the CIRIM initiative, but what we've seen come out of the Lloyd's and Cambridge studies is a large collection of losses, some of which are insurable under a cyber insurance policy and others which aren't. And routinely, when we speak to companies about what cyber insurance is and what it can do for them, the question we get back is don't our existing policies, our property policies or our professional indemnity policies, don't they provide cover for this? And there is a grey area sometimes around that coverage issue. How is the market dealing with that?
Yeah, that grey area is becoming increasingly important for the insurance industry to deal with. We call that silent cyber risk. The issue is whether insurance contracts either affirmatively include or expressly exclude cyber perils causing losses to insured businesses. The UK insurance regulator, the Prudential Regulatory Authority, has issued policy statements and supervisory statements requesting insurers and reinsurers alike to better articulate the manner in which they are dealing with silent cyber risk, and they are doing so from the perspective of both capital adequacy and also from a corporate governance perspective. Just to give you a little bit of context around silent cyber risk, Cambridge University in 2015 issued a blackout paper and that modelled the cyber impact for an outage, not dissimilar to what happened in Ukraine, but on the east coast of the US. The models that came back, best case scenario, a east coast power grid outage would represent losses in the order of $243 billion, and in a worst case scenario, just over $1 trillion. Now, when you think about the sums involved, you have to think about all those businesses that think they have insurance. They've got property insurance, they've got business interruption insurance. But if those insurance contracts across thousands or tens of thousands of businesses have silent cyber coverage, they don't really have certainty around how their insurance contracts will perform in the event of a particular cyber risk.
And what we're seeing from those insurers of more traditional lines is an effort to silo their risk, a recognition that actually these losses, cyber-related losses, which they hadn't accounted for, are now have the potential to do damage to their books. And they're seeing these losses as something which they never priced and which they aren't prepared to cover, and they're introducing exclusions. So marine policies, energy policies, you'll see exclusions in relation to cyber attacks. On the other hand, in the relatively emerging and new space of cyber insurance, we see a lot more flexibility, breadth for improvement, an opportunity for advocates of companies to really expand the scope of those policies. Are companies in Singapore at an advantage in that respect?
Well, firstly, it's important to understand some nuances of the way the insurance industry works. In a lot of jurisdictions across Asia, we have the insurance regulator that requires insurance companies to file their insurance contracts with the regulator prior to release to the broader community, and that's either mums and dads insuring their domestic risks or businesses insuring their commercial risk. When you have that type of situation, the policies, the insurance contracts, which are typically flexible, they're negotiable instruments, you lose that flexibility to negotiate a fit-for-purpose insurance contract. And as a consequence, it discourages product innovation, which is a little challenging, quite frankly, in a number of the jurisdictions. Singapore, I'm glad to say, does not have that particular nuance. Singapore, in fact, has a very strong representation of international insurers here, which allows product innovation, which allows best-in-class risk assessment to take place. And what we see here in this market is a lot of inwards insurance and reinsurance taking advantage of the Singapore insurance market and the way it operates.
Right, so we've seen then how the first three challenges we've outlined here can be addressed and are being addressed. The last one we have there is accumulation. The legitimate concern that insurers have that a cyber risk won't just target one company or cause losses for one company, but as we saw earlier this year with the WannaCry and NotPetya events, that it will exploit a vulnerability that is common to a large number of countries, leading to accumulated losses on the books. Now that takes a little more than a hexagon to work out, so Murray, I'll ask you to talk us through the next couple of graphs we have coming up.
Yeah, sure. So if you look at the graph, the bar that sticks out to the right, that models a cloud service provider outage using a probability of 1 in a 200-year event. It otherwise illustrates a 2.5 to 3 day outage. That estimate is a little bit over $50 billion, which puts that single event in the realm of some of the largest natural catastrophes that the insurance industry has dealt with in recent times. So yeah, that's the baseline. If you then think about where the insurance industry is and the cyber insurance market in particular, 2017's represented an unusually high year for natural catastrophes, particularly in the Caribbean. There's been some earthquakes. And the makeup of the marketplace, global marketplace, from both a capital perspective but also an earnings perspective, is such that the property insurance market is a deep market in terms of history, in terms of the premium pool that's been established. You've got arguably a earnings event for 2017, probably not a capital event for the insurance market, as these losses trickle through to the end of 2017. But if you look at this type of event for the insurance industry, $50 billion is a large number for a insurance market that's still in its infancy. And data would suggest that the global premium pool for cyber risk is anywhere between $1.5 to $4.5 billion, but expected to have exponential growth through to 2020, where it'll be at around $20 billion. So the question comes back, is the insurance industry able to adequately deal with these types of outlier events? Certainly from a capital perspective, yes, but from a sustainability perspective, there's still development required.
So that's looking at severity. The next graph we have here looks at accumulation risk across industries. And what do you take home from this?
Well, I think this is far more interesting. There has been a lot of debate over the last few years around the role that the insurance industry should play in assuming global cyber risk, and a large part of that debate has centered around the fear of accumulation. It wasn't so long ago that global CEOs of insurance companies were questioning whether they should be looking at this as a unique opportunity to grow a new product line or organically grow a business line, or whether it should be for governments to underwrite that type of risk. Some insurers were sitting on the fence, and if you look back, 2020 hindsight, perhaps where the industry was a few years ago, the access to data isn't where it is today, and those decisions, the positions of insurance company CEOs may not have been as informed as they would be today. Where we see the market today, however, is a very different proposition. Access to data is more available. Insurers are embracing the opportunity. The number of insurers participating in cyber risk is increasing at a very significant rate. But getting back to this slide in particular, the way insurers deal with the accumulation or aggregation risk is really important. And just to explain, accumulation risk is the total of all losses attributable to one single event. Now that could be a single event of a mega data breach, or it could be a single event by virtue of a worldwide malware attack, which we've seen this year. And if you look at that a little bit further, operating systems and cloud service providers represent one of the single largest aggregation or accumulation paths for industries. This graph here depicts Fortune 500 companies and their aggregation. So cutting to the chase, operating systems, that's the single largest point of accumulation. Not surprising given that the operating systems, there's a distinct lack of operating systems available for enterprise-wide deployment. And with that, you get the sense that this is a real problem for the insurance industry. And I would argue, in fact, the reverse is true. I would argue that having this information, having this data allows the insurers to more accurately understand both the frequency and the severity of accumulation risk, and allows the market to more accurately price accumulation risk as it considers how it underwrites and prices very large, complex commercial cyber risk placements.
So that gives us a macro overview of the cyber insurance market and the challenges being faced. What we're going to do for the last part of this presentation is really focus on FinTech companies. We know that they are booming. They are going to have insurance needs. What do they look like from an underwriter's perspective, and where will the market move for them? So we've listed on this slide the salient features of a FinTech company when it comes to an insurer's assessment of risk. And the first one there is probably the most important. FinTech companies, by definition, live at the intersection of dollars and data. Those are the two things they are primarily concerned with. And unfortunately, those are the two things that insurers are also primarily concerned with when they're assessing a risk, and when they're looking at, is this a good risk or a bad risk? So the questions that we'll get from insurers generally are, how much data do they hold or do they process, and what kind of data is that? And how many or what value of transactions flow through to what access to money do these organizations have? And so for a lot of FinTech companies, that's going to put them on the fairly high side of exposure. It's not dissimilar to banks or other financial institutions that have similar exposures, but unlike banks, FinTechs aren't likely to have the same rigorous system of risk management, of IT security. They're not going to be as familiar a risk for insurers. They have really no claims history, no proven record of dealing with losses, simply because they are mostly startup companies. So that puts them in an area of uncertainty. Not untouchable. We have seen that for some insurers, cryptocurrency companies can be seen as uninsurable. Not all insurers, but some. And that is a combination of things. A lack of real understanding from insurers as to what these companies do, the fluctuation in the cryptocurrency world, and possibly the connection that is sometimes, the associations sometimes made between cryptocurrency and those darker parts of the world. In addition to those features, and on the plus side, there is limited physical exposure for a FinTech company. So you're not really worried about physical property. And thankfully, that will keep FinTech companies out of the debate as to where do property losses that arise from cyber events lie. That is currently a debate raging between property insurers and cyber insurers. And as that moves from science fiction to reality, cyber attacks causing physical damage, as we're beginning to see, that will be a real point of tension within the insurance market. But coming back to FinTechs, it will also be important to differentiate between what these FinTech companies are doing. Many in the B2B model will have commercial partners relying on performance. So they'll be more exposed to third-party litigation risk where they fail to provide a service, or the services they provide cause the companies they're partnering with to suffer a loss. Where they're a B2C company and they're dealing directly with customers, there's going to be more exposure to individual data, so more concern on that cyber side. There is a less established and rigorous regulatory environment, and that will change. But at the moment, we hear about the regulatory sandbox. We hear about conditions being put in place to open up doors for companies. And so while that's great for fintech companies to move forward, that makes it, again, a fairly difficult risk to approach. And then what are the drivers that we're going to see for fintech companies, among other companies, when it comes to the cyber insurance market? We generally break these down into two categories. What we see here is the threat-based drivers and compliance-based drivers. And those are the external forces that make a company consider taking up something like cyber insurance. So on the first column, it's really all the headline events that we hear about and have heard about for some years now. Major cyber events, hacking events, ransomware, business interruption events, those sort of headline events that drive a company to consider its exposure. And fintech companies are obviously fairly exposed to those events, given the reliance on automated processes and on connectivity between organizations. But perhaps more interestingly in the fintech space is going to be this, what we would refer to as the non-organic pressures, drivers. So we see increasingly contractual requirements, so larger companies requiring the smaller companies with which they engage to maintain a certain limit of cyber insurance. That's been common for other insurance policies, but it's becoming common for the Googles, Facebooks, and Ubers of the world to require that of their clients. We expect to see that moving across to large financial institutions that partner with fintech companies, given the amount of data they're trusting them with. Regulatory pressure. Now, we've seen the European Banking Authority has put out guidelines recently which require fintech companies to maintain certain levels of professional indemnity insurance. So errors and omissions insurance, as it's sometimes known. And it's not a great stretch to think that that will soon extend to other policies, including crime insurance or cyber insurance. But the other one that we expect to see in the fintech space is an investor direction or an investor requirement that investments will only be made, will only continue to be made where adequate protections are put in place. And that will cut across both the security measures that we've been hearing about earlier today and risk transfer in the form of insurance. But Murray, it's not only going to be cyber insurance that these companies are thinking about. Directors and officers insurance and service provider litigation risk in the forms that they take. Talk us through how they'll be relevant for a fintech company.
Well, if you look at Equifax, which is a credit monitoring company that recently had a very significant data breach, about 140 million customer records. It's got a whole series of litigation events that are being pursued in sort of a class action environment. And that's demonstrable of a few things, including the manner in which Equifax responded to the incident, some allegations of insider trading where senior executives were dumping shares in the very period between when they first became aware of the event and the disclosure of the event publicly. We heard one of the speakers earlier this afternoon refer to, what happens to the C-suite when things go wrong. Who's the first to get sacked? The CISO. Who's the second to get sacked? The Chief Information Officer. Then finally, if the event is more significant, the CEO is exposed. Directors' liability insurance is there just to protect the C-suite, the non-executive directors for corporate governance failures when they get sued. We're seeing an increasing focus on that in particular. The other key part is the service provider litigation risk. And Andrew, as you quite rightly pointed out, it's been driven by the vendors. The vendors are very concerned about supply chain management in the cyber world or contingent business interruption. They want recourse. They want recourse beyond a very skinny balance sheet that a lot of the fintech startups have. So in the context of business partnerships, we see this as just an increasing trend where the fintech startups will require insurance as a proxy for a deeper balance sheet.
And just to finish off quickly, I'll just run through so we understand what a cyber insurance policy does and why some of these other policies are important. So we'll move to crime first, and it's important to recognise that when we think of losses like the Bangladesh bank loss, $81 million stolen when systems were compromised, that sort of direct financial loss, that loss of funds, isn't really the natural domain of a cyber policy, but requires a robust commercial crime policy. So for fintech companies dealing with money in that way, it's important to consider broad arrangements that include crime loss. And then we have cyber here, which we've listed with the numerous hexagons to represent the various moving parts of that policy. So the first party or the direct losses suffered by the company, data and system restoration, crisis expenses, business interruption loss, so that loss that companies will suffer when they're brought down, as well as some of the other losses, the third-party losses, so being sued in the event of a data breach, that sort of third-party liability, any other actions that arise out of a failure to maintain network security, and regulatory investigation, which we'll see more of in both Asia and all over the world. Those regulations are hardening. We're moving more towards a system like we saw in the US where this product arose out of, where there are stringent requirements from the regulators that will start to cost companies that are holding this data a bit of money. But that's all for us. So I'll thank you very much for your time and hope to see you over a drink with any questions you might have.
Okay, thank you.